Back to your personal bank show with president and founder of Secure Estate Management, Ferenc Toth.
Welcome back. This is Ferenc, and I'll tell you what, this radio stuff, it goes fast. I got so much information to share, and it just flies by. So let's move forward. We touched on thinking like a banker versus an investor, and protecting the downside and having a plan B. We touched on the power of compound interest, of course, and how powerful of a concept that is. Now we're going to really go into what is your personal bank? What is it? And basically what you're doing is you're creating an asset that's guaranteed and insured. You have access to capital, a good portion of it right away, and then you can earn interest on the asset and the borrowed funds, which is incredibly important. We'll touch on that further. And then you can create tax-favored income. You can actually grow money tax-free. If you do it properly, you can access it tax-free and even pass on to your heirs tax-free, which is quite interesting. Particularly, you understand why the wealthy have been operating and using this literally for centuries. So the tool we use, the financial tool, again, we could use any financial tool for your personal bank concept. A checking account or savings account would work, a CD, an annuity, a mutual fund, or any other type of financial tool you can think of. But the reality is there is one through a process of elimination that works better than any other, and here's why. First of all, we want compound interest. We want increasing income or access to increasing amount of funds every year. And when you talk about that, anything market related without any downside protection, like we spoke about thinking like a banker versus an investor, well, it just knocks those off the table. We don't want any risk of loss. You don't want to borrow from an asset that can lose value. So again, anything that subject to market risk of any type, any market, knocks it off the table. We don't want to borrow against something and lose money. You want liquidity. CDs, some annuities have safety, but they don't have a significant amount of liquidity. So it knocks those off the table for this purpose. Now, again, I want anybody to understand, it's not that I'm negative to any of these other financial tools, and that's something I always like to touch on. There's no such thing really as a bad financial tool. There's bad iterations of it, certainly, or better ones. But what I find much more common than anything else is there's a bad fit. In other words, a round peg is going into a square hole, if you know what I'm trying to say. Each of the financial tools that exist have a purpose. And if you're applying their purpose to their best capability, depending on your situation, of course, then you're going to have a great fit. Now, a nod to my compliance folks out there. They like me to say personal bank isn't for everyone. And I agree. It's not for everyone. But what I can say is I have so few people in most cases who have ever even been introduced to the idea. I shared earlier, I speak to a group of investors. I've been speaking for a number of years around the country. I have 100 investors in the room, and many very sophisticated. I'll ask, how many familiar with the personal bank concept? And I'll get 2 or 3 hands, literally. So if this is something you've never really looked at, you do yourself a favor and take a look. Consider this as an option. Again, tools are agnostic. A tool is a tool. You do a tool to do a job. You can chop down a tree with an axe. You can chop down a tree with a chainsaw, which is more efficient. So you want the tool that's most efficient, depending on your situation, to determine what tool fits the personal bank concept the best. And so in general, we found that, again, through the process of elimination, we want compound interest. We want increasing cash flow. We don't want to borrow against an asset that can lose value. That's pretty obvious. We want liquidity. We want access and use to our money in case that opportunity does present itself or the need presents itself, or we need to supplement retirement, or any of those other things where we have financial needs. Those things happen. Again, we don't want any limitations on the access to the funds in terms of penalties, age, or other type of restrictions. So the IRA 401k world in general is pretty much knocked off the table because for most people, particularly those under age 59 and a half, there's so many rules and limitations or tax penalties, it just doesn't fit. It doesn't work very well. And then, as I mentioned, if you operate this properly, you can generate tax-free growth, long-term tax-free growth, tax-free withdrawals, access to the money, and you can pass on to the heirs tax-free. Now, the tool, by the way, that does all these things is insurance. Now, when I say that, a lot of people are surprised. Now, it's not the type that most people are familiar with. It's something called high cash value investment grade. In other words, most people view insurance as an asset versus an expense. That's my biggest challenge. When I share this idea, this concept with people, the concept is not the problem. People understand taking control of their money. They love the idea of minimizing their taxes. Everyone wants more access to more funds over their lifetime. There's no problem with any of those things. When I get to the tool, some people have a negative view, or a skewed view, I should say, of what insurance can do. Most insurance tools are designed as a protection tool. You get homeowners and auto insurance to protect your home or your auto. You get life insurance to protect typically a breadwinner's income, for example, for a family or a business situation, a business partner, okay? Those are protection tools. There's nothing wrong with those tools. As I stated, every tool has a purpose. And if you have protection needs, you need to protect a house or a car or your life income, you should have those tools, okay? But that's not what I'm here to talk about. I'm talking about high cash value investment grade. This is the type that you find banks, corporations, and wealthy families tend to purchase. Why? It has a different purpose. Its purpose is to grow cash, not to generate maximized death benefit. Okay? And one of the things I love doing when I work with, share with a group is I'll say, hey, how many people in this room have life insurance? And half to 3/4 of the hands will go up, and I'll say, no, you don't. And they'll look at me, and some will even argue with me. I'll say, no, you don't have life insurance. What you have is death benefit protection. Now, again, I'm not against that. You have death benefit protection needs, as I do. I have a family. I own a business. I have those needs. I have some death benefit protection. But those are not designed to generate any cash. Some of them have a minimal amount of cash, okay? But the reality is they're heavily weighted towards the death benefit side, okay? And most financial, and by the way, over 99% of insurance contracts, some of the numbers I've seen, 98 to 99%, depending on what you're looking at, are designed as death benefit protection tools. Granted, some of them have some cash, some limited cash in them. Financial advisors will review these tools and say insurance is a bad investment. And they're right. It's not an investment. It's a death benefit protection tool. So they're looking at the wrong thing. Many advisors and experts have a skewed view of what the insurance tool can do. They don't realize there's a lot of variation. Here's what I mean. Now, again, it's radio, but I need you to picture in your mind, if you could just take a minute, not even a minute, take about 15 seconds, and I just need you to picture in your mind a teeter-totter. And on one side of the teeter-totter, put cash, and on the other side, put death benefit. Most insurance contracts have low or no cash. Term has no cash. You're maximizing death benefit. We're doing the opposite. Flip that teeter-totter on the other side, maximize the cash. Remember that movie, Show Me the Money? That is what we're talking about. Next segment, I'm going to come back with specifically how that works. If you want more information, I'd love to sit down with you and show you how this could work for you. Contact us at 866-515-6280 or yourpersonalbank.com. That's yourpersonalbank.com. And tune in every Tuesday at noon on Your Money Radio, 1510 AM or 105.3 FM.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com.